Today is bereft of any news reports that could have a severe impact on the oil market. Nevertheless, oil prices have managed to rise to almost $84 after a fairly steep drop to $82 from $86 per barrel. And this movement can be regarded as a technical rebound. Today, the US markets are closed for President's Day, so the oil market will most likely consolidate around the achieved levels. The situation will probably change only in the middle of the week, as Wednesday's macroeconomic calendar includes some important releases. Of course, there may be some political events that can turn everything upside down. However, it's rather difficult to predict them. From a technical point of view, Brent crude oil futures are currently pulling back from Friday's 3.5% collapse. The volume of long positions started to increase at the level of 82, serving as a variable support. If the current pullback persists, the quote may well rise to 85. Alternatively, the benchmark may resume losses if the quote breaks through the 82 mark and fixes below it, at least on the 4-hour chart. Meanwhile, gold has been hovering in the range of $1,825 and $1,850 per troy ounce for almost a week. On a Friday, the yellow metal posted gains along with the oil. However, its bullish run was limited by the upper boundary of the range. This movement can also be regarded as a technical rebound, albeit a belated one. After all, before that, gold lost more than $100, weighed down by a stronger dollar. Given that there are signs of a trend change in the near future, the metal will most likely return to the lower boundary of the range. However, this will probably happen only tomorrow, since today is a public holiday in the United States. Speaking of the Russian currency, its main driving force is obviously the Ministry of Finance, which has significantly increased the volume of foreign currency sales. Thus, a decline in the ruble is largely artificial. The logic is quite clear. The cheaper the ruble, the cheaper the products of domestic producers compared to foreign manufacturers. This is the way the Russian government encourages domestic production, which gains some competitive advantages in the international market. Given the extreme hardship that most domestic producers are dealing with amid an unprecedented number of Western sanctions, the expediency of such a policy is questionable. Nevertheless, the Ministry of Finance will most likely stick to it. Earlier, representatives from a number of industries and the government have repeatedly noted that the most comfortable rate for the economy is around 75 rubles per dollar. Apparently, this mark is still the target of Russia's finance ministry. According to the trading chart, the dollar-ruble pair gained strong upside momentum. However, after the price reached the 75 mark, the volume of long positions decreased. As a result, the market pulled back down, and now there is a likelihood that the pair will slide to the area of 72.5 and 71. However, the current pullback may well lead to a shift in the market sentiment. Technically, a new buy signal may be generated, and the volume of long dollar positions will surge after the price consolidates above 75 on the daily chart. And that's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.